Welcome back to Ask Me Anything by TJI. The question we received today is: should I go for growth or dividend stocks? Well, it depends on your investment objective. It is the same thing as today you buy a property. Are you looking more at rental yield or are you looking at capital appreciation? Both can make you money, but it is about which one you want to focus more on. But before that, you must know what you are in for. If you're looking for dividends, for example, then Singapore REITs usually give a yield of about 4 to 5%, and that is reasonably achievable. Ask yourself, is this what you are looking for? If today you are having, say, about $100,000 of capital, then a 5% yield is going to be giving you about $5,000 worth of dividends. This regarding any change in the share prices. So is this amount meaningful to you, or is it good enough to start with? Because you see, if you are looking at retirees who may have a sizable amount of assets, say $2 million, then a 5% will mean that they will get $80,000 of passive income a year for them. That amount, we can say, is a purposeful amount to the majority of the people. But with anything less than $1 million for your capital sum, the passive income that you generate from the dividend stocks often may not allow you to get by. Yes, it's good extra money to have, but you probably wouldn't be able to quit your job and just rely on that stream of dividends to get by your daily needs. So these are some pointers that you have to ask yourself and think about before you settle on your investment objective. Well, and I have more for you to ponder about. One of the biggest misconceptions that retail investors have is that dividend stocks are less risky and safer than growth stocks. How risky a dividend stock is depends on its nature of business or what happens in the market. During the COVID crash last year, all the stocks are not spared from the indiscriminate selling, including dividend stocks, or the best in breed called dividend aristocrat, which are companies in the S&P 500 index that have paid and increased its base dividend every year for at least 25 consecutive years. So they are the companies such as Pepsi, Johnson & Johnson, McDonald's. There is no doubt about it that these companies are supposedly recession-proof and we need to use their products during the good times and during the bad times. But take a look at the charts during the COVID crash. Just because a company produces dividends, or even the ones that have the best growing ones, or the best growing dividends, doesn't mean that they are a very safe bet. They may retrace less during crashes or go up a little more when they recover, but looking at the bigger picture, to say that the dividend stocks are safe is an overstatement. Some may also argue that while the capital losses may happen, the dividends are reliable, at least for the dividend stocks. We cannot be more wrong about this. During the COVID crash, Singapore REITs have either deferred or reduced the dividend payout to get through the crisis. For some retired Singapore investors who purely rely on the dividends from the Singapore REITs for their income, it cannot be worse for them when they need it the most. In fact, dividend stocks should be measured by the total returns, including its capital gain or capital loss, and not just the dividends it pays out. A high dividend yield may not always be a good thing for a company, as the company is actually returning a large part of its profits to its investors rather than growing the company. On the other hand, if you are picking growth stocks, of course, by that I mean assuming you pick the right growth stocks that are sound, you allow capital appreciation to take place over time, which in most cases, being a growth stock, the upside is way more than enough to compensate the regular dividends that you do not receive. Growth stocks, being growth stocks, they are companies where their expected earnings are likely to grow at a much higher rate than the average ones, and the profits of these companies are plowed back to the business operations usually, or reinvested to make the companies grow even stronger. So the tricky or the interesting part is growth stocks can also give dividends, and dividend stocks itself can also grow in the share price as well. While there are exceptions that dividend stocks may have good capital appreciation over time, like for example, Mapletree Commercial Trust or the Mapletree Industrial Trust in Singapore, I believe the purpose of this discussion today, we can just assume that is on either end of the spectrum. So generally for us, the joyful investors, we mostly prefer to go for growth stocks as we believe that we have a pretty long runway ahead and for its better upside. However, we may also deploy part of our cash on the sidelines to be invested in the dividend stocks like the Singapore REITs while waiting for better opportunities. It doesn't matter if the share price may stay stagnant, but yet when we do so, almost all the time, we find ourselves getting much more from the capital gains as opposed to the dividends collected. And this is due to us identifying the appropriate entry points to these stocks, and we buy them due to their potential as a growth stock as well. Are you new to investing, or have you been grappling with some unanswered questions in the investing journey? Send your burning questions to us at Ask Me Anything with TJI. I've posted the link in the description below.